The recording. Good evening, everyone. Welcome to this amazing series on Indias, and thank you so much for joining in. I'm CA Khania, the Regional Council Member of WRC of ICI, and welcoming all of you. Before we actually begin, may I request the backend team to please play the ICI motto, requesting all of you to please put your hand on your heart.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you so much. So, we've been organizing a lot of seminars and webinars this year as well under the chairmanship of C. Ankit Rathi ji with the theme of Ignite. And one such amazing series has been planned up on this NDS. And along with me, we have CA Shraddha Khivasara, the speaker for the day, and CA Hiram Inamdar, the coordinator for the session. We welcome you, ma'am. Thank you so much. May I now request Hiram ji to kindly introduce our speaker for the session. Hiram ji, over to you.
Sure. Thank you, C.A. Rudash Panakia ji, for starting this session and setting the stage for an enriching discussion. Good evening, everyone. It is my pleasure to introduce our esteemed faculty for today's session, C.A. Shraddha Khivasara. So, C.A. Khivasara is a distinguished chartered accountant and a company secretary with over 13 years of rich experience in conducting statutory audits across various sectors, including automotive, manufacturing, engineering, renewable energy, IT, and ITS. Okay, so currently, she is serving as a partner at a renowned Big Six audit firm. C.A. Shraddha has a proven track record of leading teams to conduct statutory audits for various large and complex clients, including those listed in this Sensex 30 and Nifty 50. Okay, so her expertise extends to managing audits of standalone and consolidated financial statements, implementing Ind AS and conducting audits in accordance with Indian GAAP, IFRS, and other standards. CA Khivasara is known for her exceptional client service, practical and solution-oriented approach, and unwavering commitment to quality and compliance. She has led successful audits, delivered impactful training sessions on Ind AS and auditing standards, and served as a trusted advisor to her clients on various complex issues. So her education qualification includes being a chartered accountant and company secretary both, and she cleared it, of course, in first attempt. And she holds a diploma in IFRS from ACCA UK. She is also an accomplished speaker, regularly sharing her knowledge at seminars conducted by accounting standard boards, accounting and auditing standard boards, and even for CPEC. We are honored to have C.A. Shraddha Khivasara with us today to share her insights on the practical challenges in auditing the renewable energy sector. Please join me in welcoming C.A. Shraddha Khivasara. Thank you.
Thank you. Thank you so much, Hiram ji. We also have CA Sharad Kothari ji, who is also the coordinator for the session. Thank you, Hiram ji and Sharad ji, for volunteering for being the coordinating, for this session. And let's welcome Shraddha ji. Over to you.
Thank you, Hiram ji. Thank you, Rudesh, and thank you, Sharad ji, for the warm welcome. So I'll just share my screen and we'll start with the discussion. Can you just allow me to share the screen?
Mishra ji, can you just check this out?
Okay, sir.
Yeah. So is my screen visible now?
Yes, yes.
Yeah. Okay. So first of all, a very good evening to all of you, and I welcome you to the session around practical challenges in audit of renewable energy sector. Now the question is why renewable energy sector? And before we go into the audit financial statements related aspects, let's understand the importance of this sector and the growing importance as well as the focus of the government around the renewable energy. So, as all of us are aware that from a government standpoint, with a population of 1.3 billion, India has a massive demand for energy to fuel its rapidly growing economy. So government has a lot of focus on the renewable energy as it is the future, or the green energy is something which is required for us to have a sustainable development in the country. Plus, in a country like us, where there is a massive demand for energy, rather than only sticking to the traditional sources, renewable energy is a source which, over a period of time, especially in the future, will help us to generate the clean energy or green energy. So, keeping that in the backdrop, let's move at the various renewable energy sources. So, if we look at the various clean energy sources, it is solar energy, wind energy, hydro, bioenergy, green hydrogen, and then there is waste, which is used to generate the energy. Out of these three, hydro is something which is now picking up, green hydrogen or hydro. Solar and wind is something which you will find is now very common, where generally you will find solar energy is the form of green energy which constitutes the major chunk of the installed renewable energy capacity in the country. So if we look at these five six sources, I think hydro and green hydro is something which is yet to become a norm, whereas solar and wind is something which has already become a norm. So you will find every another company more from an ESG perspective, especially the large ones, making investment into solar energy and wind energy because that is what is something sustainable. In addition to that, from an investment perspective, also you will find that it is a very attractive center. I would say attractive, attractive area wherein government is providing a lot of has taken a lot of initiatives and providing a lot of benefits to the players who want to enter into the sector. So, if we before we go into the discussion around audit and all, if we look at the key statistics of Indian renewable energy sector, so the potential is huge. It is 1,000+ gigawatt, which is the potential. Currently, India is the fourth largest installed capacity of renewable energy in the world. So it is fourth largest for wind and fifth largest for solar as of now. Government has a very ambitious target of 500 gigawatt non-fossil energy by 2030. And if you look at the installed capacity, the share of India in the installed capacity of the total renewable energy, it is more than 40%. So precisely 42% is our share in the total installed capacity of renewable energy. This itself speaks a lot about the sector and the growth this sector has seen in last couple of years because of a lot of government initiatives as well as the need for the future to have a renewable energy as a source. Now, what are the key growth drivers of Indian renewable energy? So, as I started the discussion, the power demand in the country is huge and it is expected to increase by almost 1.8 times. So, you can say almost two times increase is expected by 2030. Now, to meet that power demand, to meet that need of an energy which is there, which would come up, India has taken up this onus to have more and more installed in capacity or more and more renewable energy generation to meet that demand. Other than that, the another key growth driver is the target to reduce India's total carbon emissions by 1 billion tons. So there is a carbon emission, there is a target which has been set up. There are certain commitments which we as a country has made, and that is another reason for which renewable energy sector is always you will find in focus. Another thing is our target is also to make sure that our total installed capacity is almost 50% by 2030. And to achieve all this, what would be required is to have more investment in this sector And for that, government has come up with various schemes and initiatives. So for the production of solar panels in India, currently you will find large quantum of solar panels are imported in India to make sure that it becomes an attractive sector since it's a capital intensive one. Government has come up with a lot of PLI schemes around the same. So key government initiatives, if we have to just look at, is 100% of FDI is obviously a key initiative. There is a PLI scheme. There is a national wind and solar power policy. There is a green energy corridor. And obviously the target of 21% RPO by 2022 was something which government has aimed for. So if we look at all this, this gives us just a brief background why the sector has become so important over a period of time. And since there has been a lot of investment which is coming up in this sector, it becomes very important for us as an auditor to understand the nuances or the practical challenges which you will face when you will audit a renewable energy company. So before we talk about the audit or what issues we will face, let's look at the industry structure. So if we look at the structure, there is an OEM manufacturer, which is an original equipment manufacturer. So he is the one who will procure the raw material. He is the one who will procure the parts. He will manufacture the modules or the solar modules or solar panel or wind blades. And he will be the one who will supply it to the RE generator. Now, RE generator is the renewable energy generator. So if we look at the first section, which is OEM manufacturer, then we have a contractor, and then we have an RE generator. Our today's entire discussion will be more focused on RE from an RE generator's point of view, because that would be the entity who would produce the green energy. So our focus would be around auditing that entity which will produce green energy and what would be the practical challenges around the same. So what generally happens is from a sector standpoint, generally the RE generators enter into a power purchase agreement with its customers or suppliers. Now, if it is the government contracts or generally government comes up with a bidding and the lowest bidder generally wants the bid. So there, the RE generator basis the bidding enters into a agreement with the discoms or with the government to supply the energy for n number of years. If it's a private arrangement, then definitely that arrangement is between the customer as well as the RE generator, where RE generator will commit to sell a particular units or the quantity of particular units to the customer, for which it will enter into a power purchase agreement. So it could be through an online bidding with government entity. It could be through private customers as well, where a customer would want to buy the green energy from an RE generator. Now, generally, how does it operates? RE generator generally gives a contract or subcontracts the entire installation of the project or the installation of the wind or solar energy to a contractor. So if you see, there's an OEM manufacturer, there is a contractor. So RE generator will procure the solar panels or the wind blades from the OEM manufacturer. But for the entire installation, generally the way industry works is there's a subcontractor to whom everything has been, there's a contractor to whom the turnkey project has been allocated. Now, we will restrict more of our discussion around the RE generator because that's where the renewable energy audit would take place. Now, what would be the key consideration? So, as we say, when we start an audit, planning is an extremely important phase. We need to plan our audit. First of all, we need to perform an understanding of business. Now, when it comes to understanding of business, it is very important to understand what are the risks which are attached in this particular sector. So, if we have to look at the risk, if we do a assessment of sector risk, these are the critical risk which you will find in a sector. So raw material risk. So basically, what is raw material here? Here, the solar panels or the wind blades would be the raw material. Now, obviously, the price here, basis which the solar modules are manufactured or the wind blades are manufactured, there is a huge fluctuation in those prices, and those prices are very sensitive. Therefore, change in raw material prices could be a risk. So generally what happens is when a RE generator enters into an agreement with the customer, it is for a longer term, especially when it is through the government bidding. It is for around 15 to 20 years. So the pricing is locked there, basis certain key assumptions which a RE generator would consider. And if the raw material prices fluctuate significantly before he installs the project, that could be a risk which would be there. Even if it is a short-term contract with a private customer, whenever the prices would be negotiated, it is very important what is the project cost which a entity or a RE generator would have incurred. For that also, raw material prices become extremely important. Now, as this sector, installation of a power plant requires capex or intensive capex, generally you will find the industry operates on a debt and equity model, where the equity would range anywhere between 50 to 50 to 20%. So generally you will find 70-30. So 70 debt, 30 equity, or 80 debt, 20 equity. That is a very common, I would say, debt equity ratio, which is maintained as and when a company makes investment in such projects. However, having said that, it may depend upon companies' financing structures. A cash-rich company may want to completely finance it on its own, whereas a company who is looking at it more from a business standpoint may want to leverage on the debt which would be available. So, having said that, generally you will find that such type of sector is more debt ridden, or there is a lot of debt, 60 to 70% of debt which is taken by the companies. So that risk automatically becomes your risk for a sector when there is high leverage which is done by the companies. Another thing is project management risk. So before installation of the project, there would be a number of compliances and number of uh, aspects which needs to be taken care of. So the risk that the entity will be able to complete the project within a timeline is again very, very important, because if timelines are breached, generally the agreements have certain clauses, especially the long-term agreements, where there are damages or liquidated damages which are charged on to the RE generator in case the timelines are not met. In case of certain projects, the land is required to be acquired. If the land is not already allocated by the generator, by the customer, so in case of government projects, or I would say where the bidding takes place in the solar park, you will find the land is allocated in the solar park by the authority. But in case that is not the case, then the customer will have to find the land and make sure that the project is installed. So there are a number of nuances when it comes to installation of a project, and therefore there is always a project management risk which this sector has till the time the project is, I would say, installed appropriately. Regulatory risk, yes, there are a lot of norms which are there. There are policies in place. There are different norms for wind. There are different norms for solar. So regulatory risk is a risk which is required to be assessed. Competition risk. Now there's a huge competition in this sector because of the different number of players who have entered into it. So considering a good investment or a very lucrative investment opportunity in the sector, you will find a lot of players have entered into this sector in last 5 to 6 years. Therefore, there is very stiff competition, and therefore you will find that the rate at which the bidding takes place is quite low, and therefore to cut because of that cutthroat competition, there is a risk that entity may bid at a lower rate, but the project installation cost may be, there may be some overrun in the project installation cost, which may have certain impairment coming in the future. Another important issue or another very important risk is the technology risk. As we all know that technology is today evolving at a very faster pace. So the technology which is used today, whether that would be relevant in the next 5 years, 10 years, or there would be a better technology which will help to improve further efficiencies, that is a question which needs to be thought about. And therefore, the technology risk is always there, and the technology is currently evolving. So that aspect also needs to be factored into when one would be doing an understanding of the business and the assessment of the risk attached to the sector. So when you plan your audit, you do a risk assessment for the sector, and you identify the business risk. The risk which we just discussed, these are more of all business risk. Out of these risks, you need to assess which would be audit risk and which would be only business risk. So these business risk will give rise to certain audit risk, definitely. And we will talk about the audit risk in the sector in the coming slides. So the point here is, in the planning, you need to understand the sector, you need to understand the business, look at the risk which is attached to the sector. Out of those business risks, then assess which are your audit risk. Which of these risks would result into a risk of material misstatement on the financial statements. List down those risks and make sure that you perform appropriate procedures to mitigate that risk. So that is where we need to start the audit with. Another important factor which we need to keep in mind when auditing such type of companies is determination of materiality. So if I have to broadly categorize, the RE generator will be into different phases. So when I say different phases is, a company is incorporated and it is in the process of bidding for the projects. It is yet to win any solar energy purchase agreement. Okay. And therefore it is into that bidding phase. In that scenario, that entity may not have a business currently. And therefore, how will you determine materiality? That becomes a question. Another phase of entity would be, it has won a power purchase agreement. And based on that power purchase agreement, it has done certain procurement and has started constructing a solar plant or a wind plant. So those would be entities which are under construction phase. Their profit would not be there because the business operations have not yet started. And therefore, total assets would be an appropriate basis to consider at that particular point in time. Because asset is only the basis which you will have numbers in the financial statements as our operations are yet to commence. Another set of entity would be, it has won a power purchase agreement, it has installed a plant, and revenue has started. So the plant has been installed completely and it has started supplying the green energy. In that scenario, normally profit before tax would be an appropriate basis to determine the materiality. So what you need to do is, you need to understand which is the phase in which you are auditing the RE generator. Basis that, you need to determine what benchmark of materiality you would want to consider for calculation of materiality. So materiality calculation becomes very important aspect in this particular sector. Another important aspect you need to understand is, what would be the significant business processes. So in case, suppose, generally you will find, especially for entities who bid for the projects and we win the bidding and then deploy a power plant. For every project, they incorporate a separate entity because of the various legal requirements. You will find that you would be auditing, say, 8 to 10 entities of a same group which are into and each entity would be into different phases. Now, when you would be reporting, presuming internal financial control reporting would be applicable, you need to first understand what are the significant business processes and whether those processes are operating similar for all the entities in the group. So you can club together, look at it as one entity, and then have one set of population and then perform the testing accordingly. But for that, there would be certain prerequisites which are given in the ICFR guidance note, like the control operator is same, the controls which are operating at each entity is same, the controls are designed in that particular manner, reviewers are same. So if all those criteria are met, then you may consider all the entities together and perform an ICFR testing. But what would be the significant business processes here? Order to cash or sales to accounts receivable would be one important cycle. Property, plant, and equipment is extremely important because this is a capital intensive industry. So an entity would have installed a power plant for the supply of energy. So property, plant, and equipment would be an important business process, especially where the entities are under construction. In case of installed ones, there would be, the additions may not be much, but then you need to also ensure that the lives, etc., considered for the assets are appropriate. Treasury would be another key one, since I mentioned that generally these type of entities are highly leveraged. So they have a lot of borrowings on their balance sheet. So treasury becomes an important business process to understand. Purchase to pay would be another one. Payroll would be there, and financial statement closure process. So these would be few significant business processes an auditor needs to understand when it is planning an audit for a RE generator. We already spoke about the sector risk. Now let's look at the audit risk. So as we mentioned, when you start your audit, first thing which you need to do is an understanding of business. So we saw what are the sector risks which are attached. Okay, now basis those sector risks, I have plotted down certain risks which will translate into the audit risks. So if we have to correlate raw material risk, so pricing risk, basically raw material prices may fluctuate significantly. Now, what may happen is if a bidder would have considered X amount into the plant building and ended up incurring, say, Y, there would be a risk that his return may be significantly lower as compared to what was expected, because generally you will find pricing is generally fixed in such type of arrangements, especially in the long term contracts. So sales price, if it is fixed and cost overrun is there, there comes a risk of impairment assessment of property, plant and equipment. Another risk which may arise is on revenue recognition. So there are certain specific nuances. I will talk more about revenue, wherein there are certain issues which are there from a revenue recognition perspective. Especially these issues came when there was a levy of safeguard duty. There was again circulars because of which it was not applicable, GST, reimbursement of GST. Because of change in law, whenever there is a change in taxation element which comes into the picture, there is an impact which is there on such type of companies, and that will have an impact on the revenue recognition. Capitalization of projects. So since it's a capital intensive, whether appropriate cost has been capitalized and what is the life which is considered for the assets, that is another important consideration which will arise. Litigations may be there because of the regulatory compliances or different interpretations of regulations. Accounting of liquidated damages. So as I mentioned, in case there has been certain delays in the installation of a particular project, there are liquidated damages which are mentioned in the revenue contracts. So how those damages would be accounted for? And you will find that generally the RE generator will enter into back-to-back arrangement with the contractor, where he will have similar type of liquidated damages levied on the contractor as well, in case there is a default from a contractor's standpoint in delivering the project. So the liquidated damages will arise from both the sides. One from a customer contract, another from a vendor contract. So both the liquidated damages accounting need to be carefully looked at. So that is another focus area or risk which may arise. Borrowings and repayment of borrowings, that is there because of the high leverage in the sector. Now, impairment assessment of investments in subsidiaries or loans given to subsidiaries. So in case there are n number of group companies, generally you will find in such type of scenarios, there are n number of group companies and the holding company may make investment in various subsidiaries, give loans to various subsidiaries. So that becomes very critical to assess whether there is an impairment trigger of investments. So impairment assessment of PPE at individual entity level and impairment assessment of investment would be slightly different and therefore needs to be looked at bit differently when doing this assessment. Another important aspect or area of focus which could be applicable is on business combination. You will find there would be a lot of mergers and acquisitions which happens in this space. So companies invest, they bid, they construct, and they sell off. So there are various. You will find a lot of action in M&A space in this space. And if that happens, then business combination, whether it is appropriately accounted for, that becomes extremely critical for the sector. Recognition of deferred tax asset, yes, because initial years you will find company even after they are generating the solar power and selling it off, because of huge depreciation charge and finance cost, there would be losses which would be incurred. So whether the deferred tax can be recognized, whether it should be recognized, whether there is a certainty to that effect, all that needs to be looked into. So from an understanding of business perspective and looking at the sector risk, these broadly would be the large areas where an auditor needs to focus on when you are doing an audit of a renewable energy. There would be few more aspects which may come up, but these are broadly the large ones which needs to be taken care of. Now let's look at what are the nuances or what are the practical challenges in each area, and what are the key audit procedure which an auditor ideally should perform in each specific area. So if we go by risk, the first risk which we spoke was uh, around the investment impairment assessment of property, plant, and equipment. So if we look at the impairment assessment, what we need to specifically look at. See, generally what happens in the sector is uh, a, a power purchaser or a power generator will install a power plant and basis certain assumptions, and he will enter into a revenue contract. So as an auditor, we need to just assess whether the project, if we look at the life of this project, say 15 years, 18 years, 20 years, whatever is the life of the project, whether there is any trigger of impairment which would arise basis the future cash flow projections. So what is very critical here is, especially in the entities which enter into say fixed price contract, or say fixed bidding price contract for say 15 years, 18 years, they need to, you as an auditor need to verify, and management needs to prepare what would be the future cash flows which they would expect, and what is the cost which is incurred on the property, plant, and equipment for installation of that property, plant, and equipment. And you need to be satisfied that there is a sufficient headroom and there is no impairment which is required to be recorded. So basically, you need to do a project by project impairment assessment analysis. The key assumption needs to be reviewed. Now, what would be the key assumptions here? What is the discount rate? Now, as I mentioned, the industry has a lot of debt, so the discount rate needs to consider that aspect of how much equity has been infused, what is the borrowing rate. So discount rate needs to be looked into very, I would say, in detail by the auditor to say appropriate discount rates are applied. Future cash flows which would be generated. Now here the most important assumption would be number of units which the entity would be able to generate. Okay, this becomes very difficult in case you don't have a history with an entity and you don't have generation history. So in that particular scenario, generally entities basis the equipment which has been purchased, they get a third party reading done to say what would be the expected units which would be generated. And then you need to year on year track that they are able to generate those units, because that basis that only revenue number would be justified. So that is another critical assumption which would be there. Period of projection obviously becomes very important. Life of asset becomes extremely important. Other than this, an auditor also is required to perform a sensitivity analysis. So when I say sensitivity analysis, basically, in case of change in assumption, so say suppose there is a change of 0.5% in the discount rate, what would be the impact on impairment assessment? If there is some change in, say, number of units generated, what would be its impact on the impairment assessment? That needs to be appropriately evaluated by an auditor. And then auditor needs to assess whether there is a headroom and conclude on it. Now, when I say headroom is basically whether the carrying value of property, plant, and equipment is lower than the future cash flows. So the future cash flow should be able, so the future cash flows which are projected, the present value which is arrived at should be higher than the net carrying value of the property, plant, and equipment. And there should be a headroom to that extent to conclude that there is no impairment which is required to be made. Now, this is very simple when you talk about it, but it's actually a very complicated process, because there is a lot of judgment which is involved, and you will find a lot of questions coming from management. What are the triggers because of which you want to do an impairment assessment? So see, if you look at the industry and the nature of it, generally when an entity would do a bidding for a particular project, they will have their assumptions in place. What you need to just check is when they have assumed XYZ, whether that assumption of XYZ has translated into actually XYZ, or they have incurred extra cost in installation of plant, or the rate of power purchase agreement which they have entered into is very low, because of which they will not be able to recoup this investment in property, plant, and equipment. Generally, every entity who does the bidding will obviously do a homework from a business sense perspective. But because the sector and the prices of the raw material are very sensitive, at times there is an overrun of cost which happens, because of which such trigger can come in. At times there could be n number of other reasons also, especially in case of wind energy sector. You will find that the number of units generated may be very volatile year on year. So if the unit generation is not as per the expectation, as and when the as per the expectation which a company had when they had installed that particular generator or the particular wind plant, then obviously there would be a risk that they will not be able to generate enough profits out of it. So all these are the reasons because of which an auditor should ideally do an impairment assessment for such projects to satisfy itself that there are no triggers. If you come across to say there is an enough headroom, you may not do more. But for certain projects where you believe there is a risk because of XYZ reasons, you need to keep on tracking those number of units generated year on year, challenging the management assumptions, going back and having that discussion with board of directors, why you believe there is a risk of impairment, or if there is an impairment, asking management to take that charge in the books of accounts. So this is a very, very critical area whenever you are auditing any RE generator, even if it is into private business, say with private customers, or it is into bidding where it is entering into long-term contracts with the discoms. This area is extremely important and should be looked into. One more suggestion would be it is better that you use a valuation expert while doing this, because certain key assumptions would be difficult to actually review until and unless those are done by a valuer or those are looked into by a valuer. So it is always recommended if the headroom is very less, if you believe there are certain challenges around the discount rate, you may want to use a external expert like valuer to do an assessment of this. Another critical area or focus area when you audit would be around revenue recognition. Now, what is so critical in revenue recognition? Okay, let's look at recognition of revenue. So you will find generally there are very limited number of revenue transaction because a company enters into power purchase agreement with customers. If there would be limited customers in each entity, and there would be monthly invoice which gets generated. What you need to ensure is the revenue is recognized for all the invoices for all the units which were produced and received by the customer. Generally you will find there is a joint meter where the customer as well as the RE generator agrees on the units which were generated and supplied, and basis that reading invoicing is done at an agreed rate. So you need to ensure that a joint meter reading is the basis which the revenue is recognized. Another important thing is in case there are variable consideration, you need to see that it is appropriately accounted for. Now, what do I mean by variable consideration? At times, there would be step pricing to say for first 1 year, this would be the rate, second year, this is the rate. In case there are any discounts, etc., which are given, late payment charges which are there, any penalty which is levied for not supplying at a particular flow, all those may form part of variable consideration and needs to be appropriately accounted for. Another important element which generally comes into such entities is whenever there is a change in law. So whenever an entity would have bidded for an agreement, the legal position on taxes was say ABC, and after that there is a change. There is a change in the tax rate. There is imposition of certain tax. There is reduction of certain taxes. All that will have your impact on the pricing, and therefore generally you will find these customer contracts have a back-to-back arrangement wherein it says if there is a change in law on account of these grounds, the customer or the RE generator, the producer, the RE generator will be reimbursed by the customer to that extent. So this specifically happened when there was a GST which was introduced, or safeguard duty percentages had changed. In such scenarios, the power purchase agreements which were entered before that, those power purchase agreements had this specific clause basis which companies started claiming reimbursement. Now here the question is more about whether it is a reimbursement of tax or whether it is revenue. So basically whether you will get this money from a customer and you will record this as a revenue, or whether there would be a reimbursement which needs to be accounted for. Generally, the answer in such scenarios as per Ind AS comes that it is in the form of revenue, but every contract is different. You need to very closely monitor, review the terms which are mentioned there, and then conclude whether it is revenue or whether it is a pure other income which needs to be accounted for. Another important aspect here would be you will find that there would be certain challenges in some case of certain companies with regards to receivables. Now, in case of receivables, especially when the receivables are from the discoms and there is a poor recoverability, you need to do an aging analysis, perform assessment of recoverability, discuss with management why the receivables are outstanding. You can also have a look at the other companies, whether from a similar discom, the other companies are also not receiving a receivable, so on and so. So generally, there has been a lot of focus by discoms to release the timely payment, and there are a lot of clauses which have been added nowadays to make sure that the RE generator receives the payment on timely basis. But in bits and pieces, these issues are still there. And in case such issues are there, then you need to assess whether there is a disputed invoice, whether it needs to be provided for, or whether it's a specific discom who is making delay in the payment, and whether it's an industry norm and then therefore it is fine, and you need not make a provision and there's a commitment from discom to release the payments. All those aspects needs to be assessed. Again, you need to factor in the expected credit loss in case your client is on Ind AS. You need to factor in basis the past history if the payments are always delayed, especially after if the payments are received after 12 months and there is a financing element which has been because of which you need to do a time value of money discounting. That needs to be factored in whenever ECL calculations are done. So that is what largely revenue recognition needs to be focused on. Another important aspect would be around impairment assessment of investment and loan given to subsidiaries. Now, what happens is, as I mentioned, the generally a holding company will provide the loan, will make an investment in the subsidiaries, and then subsidiaries will enter into the contract and set up a power plant. Now, in case there is any trigger of impairment in a specific subsidiary, then obviously you need to assess the impairment assessment of investments also made by the holding company. So take an example, an A Limited has made an investment in B Limited and B Limited has set up a plant. So basis your impairment assessment of property, plant and equipment in B Limited, you come to a conclusion that there is a need for an impairment in B Limited. You need to also assess the impairment assessment of investment which is made by A Limited. So that is very important aspect, and both the assessment of impairment are comparatively, so though the future cash flow projections etc may remain same, but the methodology used by the valuers is bit different. So therefore, please keep in mind that whenever you have a trigger at subsidiary, you also need to see what will happen in the holdco's book from an impairment assessment perspective. When it comes to loan given to subsidiaries, again, there are various challenges. You need to make sure that there are loan arrangements, agreements in place. There are terms and conditions which are mentioned basis which loans have been given. In case there are no terms and conditions, there are no stipulated terms, there are no conditions, there's no repayment schedule, appropriate disclosure in the financial statements along with the Caro reporting should be done by the company. You need to make sure what are the rate of interest charge, whether that is appropriate as per the requirements of Companies Act. And again, you need to comment appropriately in the Caro report around the prejudicial, whether any loan given is prejudicial in the interest of the company. So whenever there is an impairment assessment at subsidiary, go back and check whether impairment of investment is required to be done. In case of intercompany loans, be very careful with the loan arrangements, terms, conditions, how those are classified in individual books, whether as per Ind AS 115 appropriate accounting has been done, what would be the implication of those from a Companies Act standpoint, and as well as especially the Caro 2020 reporting, because there are a lot of terms and conditions. If there are no terms and conditions, repayment on demand and stuff like that, there is a Caro report, Caro 2020 reporting, which may get triggered, which is extremely critical for auditor to assess. If we look at the next important area, it would be around capitalization of projects. So, see, as an RE generator, once they enter into any agreement, or if they decide to I would say, install a power plant, the capitalization cost is generally quite huge. So as an auditor, what you need to focus on here is, first of all, you need to obtain an understanding of the entire company's capitalization process. So whether they have a capitalization policy, whether that policy is as per the accounting standards, and what are the controls around capitalization. So as I mentioned it to you, that generally you will find that the companies give a back-to-back arrangement to an EPC contractor, who will then install the power plant and hand it over, a turnkey project kind of a scenario, and will hand it over to the RE generator. Now, there are different nuances when it comes to the capitalization. So, first of all, in case it's a turnkey project given to a contractor, what you need to assess is what are the terms and conditions of that particular contract, and what are the timelines which are mentioned in that particular contract. Who would be procuring material? Generally, you will find RE generator will procure the power plant, I mean the solar panels or the wind part, and the setup, etc., would be done by an EPC contractor. So for that, whether there was an order which was placed, at what pricing the orders were placed. Generally, you will find whenever these orders are placed, because these are generally imported. Now there has been a local push from a government standpoint on local manufacturing, but you will generally find there is lot of I would say import which happens in this area. So appropriately all duties etc. are capitalized or not, that needs to be looked at. Secondly, what also needs to be looked at is, generally you will find that because of the fluctuation in prices and as well as fluctuation in the currency, companies do take the forward contracts. Okay, so they do hedge their currency risk in case of such contracts, in case of such purchases. So here what we need as an auditor needs to assess is how is it accounted for? How is that forward contract which has been taken, or the I would say the cash flow hedge which has been taken by the company is accounted for in the books of accounts. So if an hedge accounting is followed, then it's a complicated assessment which an auditor needs to perform and see whether the hedge criteria are met and appropriately take the impact. If hedge accounting is not followed, then it is more or less comparatively simple. But what an auditor needs to still ensure is whatever would be the impact of the forward contracts which it had entered into is appropriately considered in the books of accounts. Another important thing which an auditor needs to look here is, because this is a very I would say highly leveraged industry, you will find that there is a lot of borrowing cost which will get capitalized into the capex. So borrowing cost to the till the time the project is ready to be used can be capitalized as it qualifies for a qualifying asset. But then the calculation of how much of the borrowing cost. So generally you will find what happens is, suppose a company is installing say 100 megawatt power plant, it will get installed in phases, say 50 megawatt, 10 megawatt, 30 megawatt. So it will never be 100 megawatt at one go. It will generally be in phases. So to what extent a borrowing cost has to be capitalized? What would be charged off to P&L? The moment a certain megawatts are capitalized, a proportionate of borrowing cost should also be charged to the P&L. So that entire calculation of borrowing cost capitalization becomes very, very extremely critical. Other things would be what employee cost is being charged to the property, plant, and equipment, whether those are that is directly identifiable cost. I mean, those are the employees who are directly working on the site to make sure that it gets ready. That is another critical aspect which should be looked at. Another important aspect would be other overhead cost. Generally, company tends to capitalize everything. Not everything can be capitalized. Other overheads which are not directly related to the manufacturing of the or to the generation of the power plant should not be capitalized. So all those overheads should be charged off, and that needs to be very, I would say, that needs to be very analyzed by an auditor in a detail to see what all overheads and what all employee cost is getting capitalized. Another very important aspect is on timeline. So generally, you will find that whenever they give an EPC contract, there will be a timeline which will be defined in the contract to say this will happen in 4 phases. First phase needs to be completed by the contractor on so and so date, second phase on so and so date. So that becomes extremely important, because if there is a delay in that, there are two implications. One is those timelines generally are linked with the customer contract. So if there is a commitment to customer to start the supply of energy in September, generally companies will ask a power plant generator to complete the installation by August. So if there is a delay there may be delay in starting the supply to the customer. And under the revenue contract, certain liquidated damages may get triggered in, where in case of delay, the company may have to pay certain penalties to the customer. So from that perspective, delay in timelines become very, very important. Another important aspect is, at times you will find that, say a customer contract says that you should start supplying the power in September, but a company has entered into a contract with the vendor to say that you need to provide it to me by July. In case there is a delay from July to August, there will be a liquidated damage which I will levy on the EPC contractor. Now, there may be a scenario where liquidated damages may not get triggered from a revenue contract standpoint, but there would be a liquidated damages which we may have a right to recover from a vendor standpoint. So in that scenario also, timelines become very important, because if there is a recovery from vendor, then we need to also assess how it needs to be accounted for, whether it will be a reduction from property, plant or equipment, or it will be recorded in P&L statement. That also there are certain criteria, certain guidances basis which that assessment needs to be done. So always keep in mind that the timelines which are mentioned in the contract are extremely critical whenever you are assessing the capitalization. Another important aspect is, as required by our Schedule 3, whether there has been overrun in as compared to the budgeted cost. That comparison also needs to be done when you are reporting the cost CWIP, work in progress, in the books of accounts. Now, how that can be done? As I mentioned, whenever a company will start installing a plant, there would be X number of assumptions which it would make, because from a business standpoint, they would expect some IRR from that particular asset or from that particular project. In such scenario, it becomes very important to understand what is the budgeted cost which management had considered, original budgeted cost, and what is the current cost which management is incurring. So in case there are any overruns, whether those overruns are approved, whether in case there are delays in the original timeline, whether those delays are approved, and then appropriate disclosure as required by Schedule 3 will come in the financial statements to that effect. So whenever you are auditing a capitalization of a particular projects, especially always keep in mind, you need to look at the process, you need to look at the controls in place, you need to look at what is getting capitalized, especially from a borrowing cost and overheads perspective, whether borrowing cost and overheads are appropriately capitalized. You need to also look at the original equipment cost which is getting capitalized, whether any hedging is done, how is it getting recorded. Look at the liquidated damages, look at the timelines with the customer contract, look at any other penalties, etc. clauses with the not only with the customer contract but with the vendor contract as well. Another issue which generally at times come up is on GST. At what rate GST would be levied by the vendor, whether there is any specification mentioned, because different vendors have taken different positions in case of GST percentages, etc. being levied. So whether appropriate rate of GST is being levied, because what happens is GST here becomes a cost for the company. So on power supply, there is no GST which is required to be levied. So there is no output. So whatever is the input becomes a cost for the company. So in case it's agreed with a vendor at a for a GST percentage at a particular rate, and tomorrow vendor, because of certain issues at his end, changes the GST percentage, because of which a cost changes, all those aspects needs to be looked at. So sometimes it happens the entire project is constructed, completed. Especially earlier, it used to happen more when the positions were not settled in the industry. Now, in last 3 4 years, there are a lot of positions which have been honestly settled. So earlier, as the sector was more new, there were a lot of nuances which used to happen where EPC contractor then used to ask for more a different percentage of GST, and your entire cost calculation will then go for a toss. So all these aspects needs to be seen. You need to make specific inquiries with the project guys to understand whether there is any dispute on any particular part with the vendor, whether any there is anything which is expected, which was out of scope, which was extra, which was done by the vendor, for which you expect further payments to come in. Because once you capitalize a plant, and after that, if there are certain discussions going on with the vendor on cost overruns, etc., then obviously that will have an impact on your financial statements. So all those discussions, all those aspects needs to be discussed in detail with the management before you conclude on the capitalization. Another important aspect around capitalization will be around the life of the assets. Now, what would be the life of asset, and whether componentization has been appropriately done by the management? That is another important aspect which needs to be looked at. Generally, you will find that some companies take life as 15 years, some take it as 18 years, some may have taken it as 20 years, but generally you will find 15 is a standard life which entities have considered. Now, for 15 years life, what is the basis, whether it is appropriate, what is the contract with customer? At times contract with customer may be lower, so whether company will be able to get new customers, all that assessment needs to be done. Technological obsolescence needs to be assessed and then looked into. So all these aspects become very critical whenever anybody is doing a capitalization of a project. If we move to next point, the next point is around accounting of liquidated damages. Now, as I told you, what is actually a liquidated damage? Okay, so in case there is a delay in a fulfillment of an obligation, so from a RE generator standpoint, he has entered into a power agreement, okay, power sale agreement with the customer. So in case he is not able to abide by those terms and conditions from a timeline perspective or from number of units perspective, then there would be certain damages which would be mentioned in that contract. Now, damages is kind of a penalty which is required, which would be levied by that particular customer. So we need to understand what are the conditions which are triggering that liquidated damage, because how it needs to be accounted for is another important aspect. So there is some guidance around that which is there in the international gap. Another important thing is from an Ind AS or AS perspective, whether it should go to PNL as a penalty or whether it should be reduction from a cost is again needs to be seen. Especially reduction of a cost will happen when there is a liquidated damage which you are recovering from a vendor. So as I've mentioned that as customer would levy you liquidated damage, you may have a similar type of an arrangement with a vendor, wherein you may specifically mention similar type of arrangements or similar type of timelines, basis which a penalty could be levied on the vendor, so that company can have a back-to-back arrangement in case it has to bear any penalty. So both aspects needs to be looked at from a revenue standpoint and from a customer, from a vendor standpoint. Generally, what you need to keep is keep your mind, or how you need to assess whether it should be a PNL charge or whether it should be a reduction from asset. So in case there is a liquidated damage which is required to be recovered from the vendor, the test should be whether what is the loss which has happened to you. Okay, so in case there is a loss which has happened, which has resulted into loss of revenue, then in that scenario, largely it will go to PNL. So take an example. There is a delay in timeline from a vendor perspective. and because there is a delay in installation of plant, you are not able to generate the revenue and supply those units to your customer. Okay. In such scenario, it is more of a loss of revenue and less of a reduction to your actual original property, plant, and equipment. There could be another scenario where there may be a scenario where uh, there may be a quality issue from a vendor end, because of which you would have renegotiated certain prices. Okay, and you would have asked or you would have claimed the liquidated damage from a vendor. In such scenario, then obviously it will be more of treatment of reduction from a fixed assets. But having said that, there is no specific thumb rule. It is more about whether it is recovery for loss of revenue or whether it is a reduction in your asset cost which has happened, a discount towards asset. That is a key principle for which you need to do an assessment. And uh, if you go and read those vendor agreements, those agreements are very tricky at times. So you will find that it will be very tricky to assess whether it is loss of revenue or whether it is reduction in the fixed assets. So that becomes extremely, extremely important. And therefore, liquidated damages accounting is very tricky. Another tricky part is when you are paying it to the customer, whether it is again a charge when you are recovering it from the vendor. So what will happen? A net accounting, a gross accounting, all that also needs to be evaluated. So in nutshell, always look for the accounting of liquidated damages, whether there is any condition which triggers that. If there is any condition which triggers that, how it has been accounted by the management and whether it is appropriate, because it is more about revenue versus capex, and this may or may not have tax implications. So at times it may have, and at times it may not have. So all that also needs to be considered whenever a position is taken, whether it is appropriate. At times clients may want to take a particular position only from a tax favoring perspective, but what we need to do is we need to take a position which is appropriate from an accounting standard standpoint. So accordingly you need to do an assessment, and then take a uh, and then assess whether the accounting which has been done by the client is appropriate or not. Okay. Another important aspect is a client may say, suppose there is a vendor agreement and there is a delay. Okay. And basis the vendor agreement, contractually he can recover XYZ amount. Now, yes, he may have a contractual right to recover. But what is again more important is whether it seems recoverable basis the discussion with the vendor, because there would be XYZ things which would have happened in the project. So the vendor could have delayed at times. The certain situations may be beyond his control, which he may have communicated. Certain situations may be where management also has not given him appropriate directions on time, because of which there is a delay. So what you need to only see, rather than only contractual right, is whether there is a possibility of that recovery. Till the time it seems extremely certain that you will be able to recover that amount from vendor, till that time that liquidated damage should not be accounted for in the books of accounts, though there is a contractual right. I have seen n number of cases wherein contractual right was always there, but basis the discussion with vendor, company was not able to recover full, or company was able to not recover at all. And at times company decided to let it go, considering the relationship with vendor, considering other things which would have happened in the project, because of which they believe that it is appropriate to let it go. So all these aspects are very important. So don't allow your client to account for it till it seems extremely recoverable. Have those discussions with the client, insist them to get you the confirmation or certain emails from the vendors wherein it is very clear that vendor is also agreeing to pay the same. So that this is another very, very important aspect. And most important thing is make sure that adequate disclosures are given. In case there is a reduction from property, plant, and equipment, it is always advisable to have a note in your financial statements explaining what has been reduced, why it has been reduced. So make sure that full disclosures are given as per requirements of the accounting standard in the financial statements. Though there is no specific accounting standard which will govern the liquidated damages, but you will find some guidance in Ind AS 16 and ES 10, which will help you to conclude how it should be accounted for. Another key focus area would be around borrowings. So if we look at it, generally, as I mentioned, these sectors are highly debt leverage. So what is more important here is who are the financiers of the company for a particular project. So from whom has the company borrowed the money, how much they have utilized their own equity funds, and how much is it from the borrowings which are taken from either the financial institution or bank or from the group companies. So if it is group company, largely it is more about terms and conditions, which needs to be looked at. Whenever there are external borrowers, the financial institutions are there, banks are there are huge agreements which are there. There are master agreements. There are two, three borrowers who make a consortium and fund the project. So you need to go through those agreement in detail, understand what is the security which is provided by the company, whether it is a lien. Generally, you will find it is lien on plant and machinery because that's what is an asset which company has. So appropriate disclosure to that effect should be given, whether a charge is created on the assets of the company. Company has done the charge creation filings. That needs to be looked at. What are the covenants? This is extremely important because at times you will find there are a number of covenants which are defined in the agreement, and different borrowers will have different covenants. And company, you need to test those covenants as defined in the agreement and see if there are breach. So in case there is a major breach of covenant, it has to be dealt with appropriately from an India standpoint. If it is an India's financial statement, if it's an IGAP, then the rules are slightly different. So you need to see whether there is a covenant breach, what has happened, whether there is any penalty which would be levied because of covenant breach, whether the loan becomes immediately repayable on demand because of covenant breach. So the event of default because of covenant breach, and what is the repercussion of that, that needs very thorough understanding in case there is a breach of covenants. Another thing which needs to be looked at is and the most important thing is external borrowing confirmations. Since there you will find most of it being funded by banks and financial institutions, external confirmation would be a very key audit procedure which should be performed. And along with the external balance confirmation, auditor should also insist on the confirmation of willful defaulter. Now, why willful defaulter? Because there is a requirement under Schedule 3 where you need to, and in the Caro report also. So in the financial statements, you need to make a comment, management need to make a comment whether it has been classified as a willful defaulter. So it is better that you take that confirmation from the bankers, where especially in such debt leverage companies. Another important aspect would be the initial direct cost should be reduced from borrowings. So if your company is doing an accounting as per Ind AS, whatever transaction fee would have been paid or whatever initial cost would have been paid to procure that loan, that should go as a reduction from the borrowings and should be amortized in the PNL or charged in the PNL as finance cost over the period of loan. So that will be the gap difference between Indian gap and Ind AS, which needs to, which may have, I mean, which will have a significant impact because your loan amounts are significant. So you will have huge transaction cost or initial cost, which will be paid by the companies. So appropriate accounting of that is very important. Another important thing would be what are the terms of repayment and when the repayment is going to start. So whether there is any moratorium period, whether when is the repayment going to start, what are the installments of repayment, what is the frequency of interest payment, all that needs to be looked into, verified whether that frequency, that repayment schedule has been followed by the company. In case there is a restructuring, you will commonly find in these companies that they will take an initial loan from XYZ bankers. After they are able to successfully install a project, generally in the initial phase, the risk is comparatively higher because the project is under installation. Once the project is installed and cash flows are generated, especially after 1 year of operations, the risk profile slightly comes down. And then the borrowers are willing to refinance it and provide a loan at a lower rate of interest. So companies you will find in every 2 3 years or basis the interest rate cycle may go for a restructuring of loans in such type of companies. So whether the company has gone for restructuring, what are the penalty clauses for early closure, how are those accounted for? Ind AS has again certain aspects to be looked into around it. So whether those penalty clauses are appropriately accounted for in the books of accounts, whether company has paid those penalty, all that needs to be looked into. Another important thing is whenever a borrowing cost is capitalized, we have seen in the capitalization also that we need to check that it is appropriately capitalized. So make sure there is an appropriate uh, capitalization of borrowing cost, as well as wherever required it is current appropriately charged off. And whenever you are looking at the payments, see that the total borrowing cost, so principal and interest, there is no default in payment of that. That is another important thing which needs to be seen. Another important thing is, in case suppose there is some circumstances in which a project is suspended. Okay, a lot of scenarios have happened in the past in this industry where companies have started the construction, but because of certain permissions not received from government, PSA final documents not entered by the government on timely basis, company had stalled the project and suspended the projects. Now, in case a company has taken a borrowing, the interest clock will always keep on running. So that interest for a suspended project is not allowed for capitalization as per the accounting standards. So what needs to be seen is, in case there is a suspension of project for any reason, the borrowing cost is also suspended. So it can be capitalized then. That needs to be closely looked at. So I think from a borrowing standpoint, these are extremely critical points which should be seen by an auditor whenever you are doing the audit. Now coming to business combination. So in this industry, you will find a lot of business combinations will occur because companies try to acquire and then grow in the space. And companies at times when they get lucrative returns also, they sell off the assets which they would have generated or they would have created. So business combination that way is very frequent in such type of industry. Now, in case the accounts are prepared under Ind AS, there are a lot of aspects which needs to be looked into whenever there is a business combination which happens. So the most important thing is go through the share purchase agreement to understand what are the terms and conditions of the acquisition. That is extremely critical. Another important thing from a business combination or Ind AS 103 perspective will be whether it is an asset acquisition or it's a business acquisition. Okay, now it is argued whether it's an asset or it's a business. It all depends upon what has come into the process, whether it's only an asset acquired, it is through people are also acquired. I mean, employees are also taken over the role. There are a lot of different views which are there, and there is I would say, an element of judgment which would be applied by management in assessing this. Therefore, one needs to do a detailed assessment of whether it's a asset acquisition or a business acquisition. Another important thing is then determination of fair value for assets and liabilities which are acquired. So as per the requirements of Ind AS, whenever there's a business combination which takes place and it's a business acquisition, if you conclude it's a business and not an asset, then a detailed asset and liability evaluation or fair valuation is required to be carried out. Okay. So company needs to go to a valuer, engage an expert valuer and get an asset and liability fair value. So those fair valued assets and liabilities are the assets and liabilities which will at which you will account for the combination. Okay. Whenever there is a fair valuer involved, assess from an audit standpoint to involve an expert to do a evaluation of the assets and liabilities or the fair values which are identified by that particular valuer. See whether he is a registered valuer, assess his competency, look at what are the assumptions which he has mentioned when identifying those assets and liability. It's better to involve an expert. Another important thing is assess what is the goodwill which will arise in that scenario or whether bargain purchase. Now, as per the Ind AS, generally you will hardly find a scenario of bargain purchase. It is more of a goodwill which will be recorded. How that intangible, whether there is an intangible which is identified in the fair valuation of assets and liabilities, whether at what would be the life of that intangible, if any, which is identified. Goodwill, again, there are goodwill needs to be tested for impairment at every year end. So all these aspects are very important Whenever there is a business combination, you need to go through the agreement. You need to see whether it's a business acquisition or an asset acquisition. Get the fair valuation done by management from an expert. Look at the fair valuation and then go through the business combination standard and ensure that the appropriate accounting has been done. So all assets and liabilities are recorded at fair value. Goodwill is appropriately recorded. In case there are intangibles identified in the process, what is the life which is assessed for that intangible? Generally, valuer will do all that assessment in his purchase price allocation report. But you need to make sure that valuer is competent and objective enough to do it appropriately. You can also see a lot of industry practices in this. So there are a number of companies. There are companies in listed space as well in this. So you can see the industry practices and their financial statement disclosures and make sure that adequate disclosures are given in the consolidated financial statements for a business combination which has happened. Another important area would be around litigations. So we need to obtain list of litigations against the company and assess the nature of those litigations. So what are the litigations? Whether those are pertaining to any tax demands, whether there are any litigations around the acquisition of land, all that needs to be assessed. So you should first take a list of entire litigation from the company, understand the management's assessment along with their experts, their lawyers, their legal counsel. You need to sit with them, understand what are the nature of this litigation, what is their assessment of a probability that this litigation would devolve or would result into any amount of demand on the company. What is the legal footing around the same, whether they have taken any opinion from any expert counsel or from any legal counsel to conclude that the litigation would not result into a tax demand. That needs to be seen. In case required, it is important that you also involve the experts. But I think a lawyer letter from a reputed lawyer with a detailed understanding may help you to assess whether it is appropriate. In case there are other tax demands, then you should ideally involve the experts to see whether it is appropriate to disclose it as contingent in nature or a provision is required to be made. Another important point is around deferred tax. Now, as I mentioned, that since these are companies with high or capital intensive and huge borrowings, the finance cost will be huge as well as the depreciation will be huge in this. So you will find that in initial years, companies will make loss for a particular period. And then over a period of time, if it is able to generate the expected units, then it will turn into profitable. Now, what happens is in the initial years when company makes losses, companies may want to create a deferred tax asset on those losses. Now, as an auditor, what is your role or how will you evaluate whether a deferred tax asset should be created? Okay. So for that, what ideally should be done by a company, a management should do an assessment of future taxable profits. So any which ways they will do an assessment from an impairment standpoint. Similar set of numbers they will use, and they can compute the taxable profit, future taxable profit, and see whether in how many years they expect a company to turn around and may start making profits. So there may be a scenario for say for 6 years company would be incurring losses from a tax standpoint, and from seventh year onwards company will start incurring taxable profits, and then your losses will be utilized against the future taxable profits. So that detailed assessment is required to be done for company by the management for you to assess whether the losses or the deferred tax asset can be utilized against the future taxable profits. Now, one important aspect which you should keep in mind is under Indian GAAP, it talks about creation of deferred tax asset only in case of virtual certainty. So virtual certainty means the level of evidence which you need as an auditor would be very high to conclude that company will be able to generate future taxable profits. So the assumptions which management will consider, those needs to be appropriately challenged, and you need to be satisfied that it seems appropriate that they will be able to generate future taxable profits. In case of India's, it is reasonable certainty and not virtual certainty. Still, you will need an evidence, but obviously virtual certainty requires a very high level of assurance as compared to a reasonable certainty. My practical take on this would be largely you should avoid and you should not allow management to consider to recognize deferred tax assets in the initial years till the time you have a history where you can see that the company is able to uh, generate the revenue as expected by them, because it all depends on what number of units they are able to generate and what it would be the revenue which would be generated. The cost or the PNL in such type of companies is very light. You will have a finance cost, you will have a depreciation, expenses will be largely around operation and maintenance of the particular power plant, for which they will generally enter into an annual maintenance contract. So that cost also would be largely fixed. It's a lean payroll led company. So you will find number of employees in such companies are very low, because it's completely the plant which would do the entire supply. So payroll cost would not be honestly a large number, and other expenses also would not be significantly high. So it all depends upon what number of units they are able to generate, and whether those number of units, if generated, will provide you the future taxable profits. So try and avoid, tell management not to create it in the initial years till the time you get that evidence. Once you can see that, okay, they are able to generate, they will be able to generate future taxable profits, losses could be utilized, then you can think about taking a stand where a deferred tax asset can be created, and then it could be utilized over a period of time. So you will find challenges around deferred tax as well. One important thing which we as an auditor should keep in mind is, whenever you are using any future taxable profits, you should make sure that management is providing you a similar set of numbers for impairment assessment, for goodwill assessment, for recognition of deferred tax. So it should not be different cash flows being used by management, and we as an auditor relying on different set of cash flows. Because as an auditor, then you are questioned how you can have different set of cash flows. You need to question that to management. So make sure a similar management uses similar set of numbers for all the critical assessments which would be required to be made for future taxable for future cash flows. That is and I would say a very important point, because at times people work in silos and impairment assessment may be performed by finance team and tax team may do something else. So make sure that that doesn't happen, and appropriate cash flows are used by each party. Now, these were the critical areas, or I would say areas of focus from an audit standpoint, which an auditor should focus on when we are doing a renewable energy companies. Now, what are the significant estimates which are generally used by such companies in preparation of their financial statements? Useful life of asset is a very significant estimate which companies use. So as I mentioned, generally 15 years is the life which is used, but companies may tend to use higher life. It all depends on what technical assessment they have got. From an India standpoint, or from a world standpoint, solar companies have that way not become 15 years old till now, though wind may have become to have that history. But soon you will find that over a period of time, because this industry was new, you will find that over a period of time you can assess whether actually 15 years, 20 years a solar park or a solar panel is able to operate or not. Another very important consideration here is on technological obsolescence. So uh, I would say the solar panel may be able to operate, but what about the technology which has been upgraded now, because of which whether it is efficient for management to continue to operate? That is another thing which needs to be assessed. Another important aspect is around impairment assessment of PP, subsidiaries, investment in subsidiaries. Again, here all estimation will be done by the management for future cash flows. These are very, very significant estimates. As an auditor, we need not accept them at face value. Look at the critical assumptions, challenge the management why they have considered those assumptions, do a sensitivity to make sure that there is sufficient headroom. In case the headroom is not sufficient and you believe the assumptions are okay to go with, make sure that you are communicating with those charged with governance or board of directors in case of private companies around such key assumptions which have been considered by management. In case deferred taxes also, there are significant assumptions which we spoke about in case of deferred tax asset. Provision for gratuity and leave encashment here, I would say it may not be very, very significant because generally you will have lean manpower. But yes, there are certain assumptions which may be used there as well. Impairment assessment of goodwill. Again, now, in case there is any business acquisition which happens, there is a generally a goodwill which gets created in the consolidated financial statements of the company. Now, to do an impairment assessment of that goodwill becomes very, very critical. Now, there are various views in the industry, actually, whether there is any goodwill in this industry, whether what is the goodwill which will get generated, how will you test it for impairment? There are a number of complex questions which arise around it. But you need to make sure one thing, in case you recognize any goodwill in the financial statements, it needs to be tested for impairment. In case you are not able to test it for impairment, then there is a question that how that goodwill value is justifiable. So that assessment needs to be done at least annually. Fair value measurement of financial instruments, again, very, very critical aspect around fair value measurement. Litigations, yes, litigations again need judgment and judgment part of management to assess whether there would be any potential demand which will arise on the company or not. So, in nutshell, these are certain critical significant estimates which will be used by the management in preparing the financial statements. Now, let's look at certain key Schedule 3 disclosures. So, certain Schedule 3 disclosures which will apply to such type of companies would be obviously aging of CWIP. I think we spoke about it to say what was the original cost, whether there is a cost overrun, what was the original timeline, what is the revised timeline, whether there is any delay on or whether there is any change there. That needs to be disclosed appropriately in the financial statements. What about trade receivable? What about trade payable aging? That needs to be given in the financial statements. Because there are a lot of borrowings in these companies, there may be borrowings where quarterly returns are required to be filed with RBI, borrowings taken around the same. That reconciliation of quarterly returns filed with the banks versus books is required to be given in the financial statements. Utilization of borrowed funds for purpose other than those specified. Again, this is very, very important because there are term loans which are taken from banks, there are funds which are borrowed, whether those are used for the purpose for which they were taken or they are not used, I mean, they are used for some other purpose. That verification is required to be carried out by the auditor, and then suitable disclosure in the financial statements will be given by management, and a suitable disclosure in the CARO will be given by an auditor. Loan granted to promoter, directors, related parties. In such companies, you will find a lot of loan between intercompany loans. So the appropriate disclosures for intercompany loan should come in along with the terms and conditions which are given in the agreement. In case there are no terms and conditions, whether those are repayable on demand, appropriate reporting in CARO is required. All that is very, very significant. Similarly, with relationship with stock of companies. So I think this is not very complicated, but yes, that will also apply. What would be other key considerations which would be there when you audit such companies? Going concern assessment. Now, when would a going concern assessment trigger, basically? Suppose there is a company which has been incorporated, which is, I would say, which is bidding for projects, but has not got any projects. So you need to see, and there is a negative net worth. You need to see whether you need to take an holding company's support letter that they will be able to fund the negative net worth. You will need to assess the going concern of that particular entity. Similarly, suppose there is an entity in which there was a project which is now abandoned. What will happen to those assets and liabilities? What will happen to that going concern assessment? That also needs to be seen. Review of projects wherein there is delay is foreseen. So what you need to do is whenever you are auditing such companies and especially group of companies, for all the projects which are there, you need to keep on having a discussion with the management to see whether there is a delay which is foreseen. Because we spoke a lot about liquidated damages on both the sides, vendor as well as the customer. And so you need to closely monitor the status of the project, any dispute with the vendors. All that needs to be very closely done. And therefore, any delays in the project needs to be very closely monitored have a dialogue with the project team, have frequent discussions with the management, understand the status of project, understand whether the timelines will be met, understand whether there is any change in original timelines. That is very, very important. In going concern assessment, I think we spoke wherever there is a negative net worth or you find an indicator of going concern issue, there has to be a financial support letter from the holding company. Now, whenever you are taking a holding company support letter, please assess before relying on that support letter whether the holding company's financial position is viable enough to provide that support letter to subsidiary. Another thing is if a holding company has say 100 subsidiaries, to how many subsidiaries it has provided that financial support letter, and what is the negative net worth of those subsidiaries, and whether the holding company has that position to fund all of those or whichever out of those may go bust. So that assessment is very, very critical. Taking a support letter is very easy, but before you rely on that piece of paper, assess whether it is reliable, assess whether the holding company's financial position is good, what are the commitments which holding company would have given to other subsidiaries. That assessment should be done before you place any reliance on a support letter. What would be other reporting requirements under CARO? So there would be additional reporting requirements under CARO for such type of companies, whether there is any default in repayment of loans or borrowings. That needs to be seen. Fraud and whistleblower complaints, it's common for all companies, whether there is any fraud case, whether there is any whistleblower, that needs to be reported. In case of intercompany loans, again, there would be a reporting requirement which will come into additional reporting requirement on investments given, guarantees provided, securities provided, loans granted. All that will come into picture. So from a CARO standpoint, largely it would be around loans, borrowings, utilization of the funds for the purpose for which it was raised, investments made, compliance of 185, 186, all that will be very critical from a CARO standpoint. Another important aspect which is there in this industry, and I would just like to touch base, though I have not covered that in the presentation. There has been a lot of discussion going on carbon credit or the I would say CER. It's kind of a carbon credit wherein the company which is generating the renewable energy, whether they will be able to get those credits basis which they can sell it in the market and earn the revenue. Now, since this is not a new concept, this was there earlier, but it never kicked off. This has again come into picture. But what I would say as an auditor, the practical challenges which you need to be aware of is before recording any income in the books of accounts, make sure whether they have got those credits in their account. Make sure whether they are able to find a buyer to purchase those credits. Okay, these two are extremely critical. And what is the price at which they will be able to sell it? Okay, at times there has been a issue with the uh, non-availability, or there is no demand for purchase. The prices are extremely low. At what price that revenue should be recorded? And the most important thing is whether they have a right or they have actually received the credit, because there are certain registrations, etc., which are required to be completed to get those credits. So whether they have gone through that process, they are now entitled and they have got those units, or it is just a contractual right because of the business in which they are, basis which you are recording. So my answer would be very careful. Record it only when they are entitled to those credits and they have completed the formality to get the credit. Now, at times there are n number of terms and conditions. Some they may not be even able to achieve. So therefore, it is very important to see whether it's only a mere formality or actually there are terms and conditions which company can achieve or not. So be very careful when such income would be recorded by the client in such scenario. So with this brings me to the end of the presentation. Hope this presentation and today's discussion would have helped you at least to some extent to go back on your clients and apply it practically and do a better quality audit when it comes to auditing the renewable energy sector.
Uh, many thanks to Shraddha Madam. On behalf of all the participants and WRC team, we thank you, ma'am, for the enriching session and valuable insight that you have shared on the very relevant topic of the renewable energy sector. If there are any questions, participants, please, we may raise to ma'am. Ma'am, there is one question from Rushabh Sancheti ji.
Yeah. So we provide EPC services to IPP. So what should be the criteria for recognizing revenue? So what I understand from the question is the client is providing the services, or the company is providing the services to the renewable energy generator. So this is question more from a contractor standpoint, wherein he is acting as an EPC contractor. So see, generally in case of an EPC contractor, from an Ind AS 115 perspective, you need to do an assessment how the control of an asset is transferring. So if the control of an plant is transferring over a period of time, and generally in such scenarios, it will transfer over a period of time, because you hand it over as and when you install the project. So there would be milestones defined. Generally, it will transfer over a period of time, and then you will have to do a POCM accounting. Having said that, go through the terms and condition. If it turns out to be a very small project where you will hand it over only at the end, then you need to again do a reassessment. But if you ask me a generic answer, it seems to be more likely over a period of time.
Thank you, ma'am. Any other questions from participants, please? I think there are no queries, ma'am.
Yeah.
So again, very thank you for
Thank you
sharing,
so much. Thank you.
and we may conclude this session.
Yeah. Okay.
Thank you.
Yeah. Thank you.